Hello and welcome to Exchange Traded People. I'm your host, Michael O'Riordan, and today's guest is Mike Castino, President of Sound Capital Solutions. Mike, welcome to the show.
Thanks very much, Mike, for having me. It's an honor and a privilege.
Oh, it's pleasure's all mine. So, Mike, I typically kind of like to split these conversations into two parts. The first part is kind of like a little bit about you, your background, how you get into the industry, so people can know a little bit about you. And then the second part is your kind of thoughts on the industry and where things are developing. So to dive straight in, my first question for you is, when you were a kid, what did you want to be when you grew up?
That's an easy one. Every kid has a sports fantasy, and mine was baseball. And
Baseball, right?
Yeah, I'm dating myself here, but my childhood hero was Johnny Bench from the Cincinnati Reds, because that's the position I played, catcher. So up until reality struck, meaning I couldn't compete past a certain level, that was my goal. And then reality set in. And
what age were you when reality?
Yeah, it was pretty easy for me. I think I could have probably given it a shot and done pretty much at Division III college baseball, but I had aspirations for Division I, and I found out very quickly that I couldn't do it and was pretty much relegated to catching batting practice all day. That's the only reason they kept me around. So I didn't do that. Not a lot of fun.
High level sport is brutal, isn't it? It's it really takes something to get to the very top.
It's a huge commitment, especially nowadays too. So
yeah. Well, thankfully for the ETF industry, you weren't good enough at baseball, and you right. moved into this space. So like, talk us through your career. How did you kind of get your first job in the industry, all the way up to what you do today?
Yeah, so I stuck around at the college that I was at rather than transfer and go anywhere else. And back then, I just had the typical college aspirations. Let's get a degree. Let's jump out there and see what this world is all about. But being from Chicago, I actually had a cousin who was a trader on the floor of the Chicago Mercantile Exchange. And one winter break senior year, before everyone had to start polishing up their resumes and buying a suit and doing interviews, he took me on a tour of the floor. And I was instantly hooked. Right. I wanted to go down there. I didn't care what it took. Wanted to go down there and compete. And I was just enamored by the world of futures trading at that point. So went back to college, didn't do any interviewing, didn't do anything except get right out of school and go down to the floor. I got a yellow jacket. I became a clerk and wound up over the course of a few months to a year, scraping enough together to become my own trader, to become a local trader. And I started my career trading Japanese yen futures at the Mercantile Exchange as a local.
Wow. And how long did you do that for?
Yeah, so this will be the condensed version. So I thought everything was great. I'm a young 20-something-year-old making a fairly decent living, saying this is fantastic. I'll do this till I'm 50 and I'll retire. Along came electronic trading.
Yeah.
And at the CME, one of the first pits to start doing electronic using handhelds at the time was the yen pit. And everything migrated to the screen. They brought on the E-mini contracts versus the big futures contracts. At that point, somebody introduced me to this new futures contract called the QQQ, just when the NASDAQ 100 came on the scene. So I went up to that pit and tried to make my living as a local there. And I did so for quite a while. And interestingly enough, I got tapped on the shoulder by a friend who worked for Susquehanna. I didn't know what Susquehanna was. I didn't know what ETF arbitrage was. There were a few people leaving Susquehanna at the time to form Jane Street Capital. So long story short, I worked for Jane Street in the Q pit, wearing an aviator headset, talking to people in New York, and that's how we did ETF arbitrage. They had the electronics, I had the futures, and whenever there was a mismatch between those, we'd instantly offset buys and sells and arbitrage the difference.
Got it. That sounds cool.
It was great. And this part won't surprise you, Mike. Guess what happened next in the queues? Everything went electronic there. And there was no longer a need for me to be a part of Jane Street doing the role that I was doing. So I went back to being a local in the QQQ pit. And then eventually the volume and the flow in that pit got overwhelmed buy the on-screen or the electronic, and the liquidity in the pit dried up. That's when I kind of made a transition from the floor. I kind of bit the bullet a little bit and said, hey, I got to reinvent myself. Actually found a job with a firm called Claymore ETFs, which is a legacy firm that's purchased by Guggenheim, now owned by Invesco. And I went over there with the knowledge of ETFs, and they were starting there. And that's where my journey began.
Got it. And then from Claymore, you went to, was it US Bank after that?
There was one stop in between there. I actually worked for Zacks Indexes, and I was helping them on an ETF project that at the time never came to fruition, but our service partner was going to be US Bank. And US Bank said, hey, we're looking for somebody here to help us do exactly what you're doing now for our clients. And that's what led to US Bank hiring me.
Gotcha. And you were at US Bank for quite a number of years, right?
Yeah, over 13, just under 14. And at the time they were a mutual fund service provider, and they had several series trusts, and they had full capabilities that they were building out at that time to service ETFs. So I jumped on board as a business development officer and really helped, along with a lot of really great colleagues there, put together that operating model at the time where we really focused on a lot of great startup opportunities for firms just getting into the ETF space.
Got it. And what made you leave US Bank and start up Sound Capital?
Oh, sure. So everything was fantastic at US Bank. My colleagues there were great. There was nothing wrong with it. I kind of got the entrepreneurial urge again in about, I don't know if it's a 13-year itch. Everyone calls it a 7-year itch. But I said, hey, I really want to do something here that kind of bridges the gap between, okay, you're getting in the ETF space, you've either got the ability to do this yourself with minimal help, or at the time, a lot of the white label advisors were coming on the space. ETC had been there. I'd worked with ETC. They were one of our clients, and they're still a client of US Bank. And there were others coming on, and some of those new ETF white label sponsors, I had helped put their operating model in place for them. So I wanted to offer some optionality at Sound, and we do full service white label. We offer platform services there, but we also offer this thing called the solutions provider offering, where, for lack of a better word, Mike, we handhold people that we believe can be their own advisor, kind of hide behind the curtain and make sure that they're doing everything, but we want them to be the face of the franchise to the industry with our support services here at Sound.
Got it. So obviously, you've been in the industry for a long time, been around the block a couple of laps. So when you look back at your career now, what are the kind of like learnings that kind of spring to mind that you took, and what advice would you give your 21-year-old self now?
Oh gosh, sure. I mean, that's a great place to start, because you can imagine, coming off the floor of the Chicago Mercantile Exchange at a young age, kind of you're in control of your destiny. You have bad days, you have good days, but you're trading, and what you make is yours. And it's a fairly lucrative opportunity for someone in their 20s versus somebody who gets out of college and is trying to climb the corporate ladder. So one of the things specifically that I would tell anyone, and that I missed a little bit when I was there at Claymore, is be willing to listen to other people. I'm not saying I went in there and I was cocky and I thought I knew everything, but yeah, there were instances where, well, for the last 10 years, I was a successful floor trader. Why am I here on the phone making calls about a closed-end fund raise up? I can offer so much more. So I would have needed more patience, and I would have needed to listen more to those at Claymore who provided a lot of great advice and a lot of great support to me. So that's definitely one thing that I would have done differently in the early stages. Yeah,
I think listening is definitely a skill, right, that most of us don't have.
Yeah, no, it really is. And, I was able to learn from a lot of really smart people, and I'm really grateful for what they gave me. And one of the other things that they helped me develop was kind of the sense of this: as you continue to grow in your career, this may sound a little bit strange, but I'll clarify it. Be able to say yes to everything. And what I mean by that is, if somebody asks you a question and you have those services and you're offering them, make sure you can say yes and articulate exactly what the yes is. Don't be afraid to say, no, we don't have it, but you follow up with, I don't have it, but yes, I can find a resource for you, or I know where to go. We got a cliche here in Chicago that says, I got a guy for that.
Yeah.
Or I have a girl for that, or a woman for that. But my point is, always have a resource. You don't necessarily always have to be the expert, but the ability to say yes to something, whether you deliver it or whether one of your resources can deliver it, is really critical when you're dealing with people who need that type of assistance.
Yeah, absolutely. Totally agree with you on that one. All right, cool. So like going onto Sound Capital. So you mentioned a while ago that you're a white label provider, but also working in an advisory capacity, helping other managers sort of build their own platforms. That's kind of like when I look at the other white label providers out there, none of them are kind of doing that, to the best of my knowledge anyway. They're just a pure white label platform, and they want your business. But you guys are kind of doing it a little differently. Why did you decide to kind of set it up that way?
Sure. I think the best way to kind of explain it is, we have a tagline that we've had from the beginning here at Sound, and our tagline is, we help you find the right label. And what we mean by that is, we are an ETF shop, but if an ETF is not right for you, we're not going to put the square peg into the round hole. And one of the reasons we say help you find the right label is there have been times when we've been in discussions with people and we've said to them, you know what, ETF's not the right product wrapper. Whether that's because of the strategy they're trying to implement, or more importantly, Mike, it's because a lot of people don't start with their AUM destinations. Give you a 2-second example. We ask people to take a real critical look at AUM in 2 categories. What's captive? What do you control that can be brought to the product? And what are you trying to go out and capture? The capture part is the cat laser dot in the ETF industry, where everyone's saying, look over here, I solved for distribution. I can tell you how to raise assets. I can tell you how to go out there and compete and get 1% of the SPY. You and I could talk for hours on that topic because we know the reality of it. But if somebody comes to market, for example, with captive AUM in an SMA, and they say, I want to do a 351, I want to create a bespoke product, an ETF, for the use in my business for my clients, that's a pretty easy answer there to say, yes, an ETF is going to be right for you. But if someone comes along with a hedge fund strategy and they really, really want to be active, and they want to trade 24/7, you got a deeper conversation there, because that might not be the right wrapper for you.
And the clients that come to you, do you think they're kind of coming in with their eyes wide open, or are they coming in with the sense that, like an ETF is basically like a magic bullet that's going to solve all of our problems?
Yeah, I think one of the things you can go back to is that captive versus captured. So the captive part of it, and I'll pick on the 351s for example. A lot of people do direct indexing, and there was a period recently with the tariffs that allowed those direct indexers to shine because they could take some losses and then reset the positions and do that. But you and I both know that in a kind of a straight up market, the opportunity to mitigate and defer those gains to the share price of the ETF versus direct indexing just isn't there in a straight up market. So for example, if I've got a pool of captive assets with my client and they really, really have that long-term investment strategy where they want to defer those gains to the share price and keep compounding returns instead of paying them out, whether it's a mutual fund or an SMA, then that ETF is going to be a great product in the portfolio for their clients. Mike, they may never care about raising another dollar outside of that ETF because it's a great tool for them in their practice. The other side, when folks come in and they say, I'm going to go out there with a great campaign, I'm going to do an email blitz, a calling blitz, a digital blitz, all that's possible. You know this world, you're an expert in it, and you can craft a strategy for these folks. But I'll pause after I say this. What happens when the reality strikes them that they have platform fees or data package requirements or revenue sharing? I would say, Mike, that a lot of folks are not aware of that. And forget about due diligence, but that's a tough conversation about getting your checkbook out to try to get access.
Yeah. I'd like to be a fly on the wall for some of those conversations.
Yeah.
When we kind of look at the white label space in the US, it's a very competitive market there right now. Do you see room for more new entrants, or is it kind of becoming a saturated, or are we at saturation point there?
I don't think we're at the saturation point, because I think what we've seen over the last couple of years is we've seen this whole I've got a platform offering morph a little bit. You've got the firms that are out there saying, this is all we do. We just do white label. We've got our own trust, or we've got series trusts that you can go into at different service providers, but our focus is 100% white label. Believe it or not, there's about 6 or 7 firms, probably more, who really do white label, but some of them are subtle, Mike, where they say, I'm not really advertising so much that I am a white label provider, but if you come to us, I will act as your advisor, and I'll hire you back as the sub or help you do the trading. So there are those who have the neon sign on their marquee, full white label 24/7. And then there are a few creeping in that are kind of white label light. So I don't expect that to stop, to be quite honest with you.
Interesting. A lot of clients who look to white labels for solutions often assume that they can outsource distribution as well. Now, obviously this is a big, as you said, we could talk about this all day, but when you speak to clients or potential clients about, we're just going to outsource, we're outsourcing everything. What like regarding the distribution side, what do you say to those guys? Because you don't offer any distribution services. It's just the platform only, correct?
Yeah, so a little point of clarification there. I think when you look underneath the hood, when people say we offer distribution, many times there are third-party resources that are pulled into the equation. So to clarify what we do, as going back to my statement of saying, say yes to everything. If somebody asks me, can you help me with distribution? I say, yes, 100% I can. And then what I'm doing is I'm introducing them to people like yourself or other third-party resources, because here's the critical part that we believe. We believe right out of the gate, you should control everything from the messaging to the cost to how your brand is put out there, who's going to be the face of your franchise. So there's a ton of distribution services that are out there. And to put a final exclamation on that whole thing, Mike, we don't just talk about going out there and raising assets. We say you better have a plan to both gain those assets and retain them, because a lot of people forget about the back end.
That's a good point. Yeah. So do you believe in the concept that you can, like, distribution is something that can be fully outsourced? Because to the point about you need to control the messaging. When it is outsourced, well, that means you're not always in control of the messaging, right? So what are your views on that?
Sure. So not gonna stray into this area and say I'm the be all end all expert in it, but I'll just use 2 quick examples. There are a lot of folks in the ETF industry, financial advisors, retail folks who, great, they get an email notification or they watch a digital ad on one of the websites, and what's their first move, Mike? They go right to the website, right? And they look at that ETF's website. Does it have the information there? Does it have the data? Does it have the performance to make them be able to make their own individual decision? Whether it's the CIO at a family office or an RIA that just left a wirehouse. That's that category of folks who say, don't want to talk to anybody, but I want that information at my fingertips to make that decision. So that's one category. The second category are folks that will respond to an email or a call. And what you want to do then is to be able to funnel those folks back to your franchise to get in touch with the right people. Whether that means, is this person who's calling and reaching out to us, are they in need of a conversation with our PM to really dig into the nuts and bolts of what this ETF does and how it's going to perform in this market versus that market? Or do they want to talk to a product specialist or a capital markets person here who can explain, hey, your ETF is great, but it's got 10,000 shares average daily volume. I want to put in 100,000 shares today. What do I do? So it's that person who may even need that soft touch interaction with the ETF sponsor, or they rely on the website completely.
Yeah. We've seen like a lot of mutual fund managers pivot into ETFs over the last couple of years. Do you see the same thing occurring with hedge funds in the US?
I think the hedge fund folks will first go back to, who's your AUM audience. If they're staying in that bucket where it's folks who demand a certain strategy and they're in a certain demographic, they may want that hedge fund. But if they want to tap into retail, or if they, dare I say, ever want to be on a wirehouse, or maybe they do have a friendly wirehouse that says, we love your strategy as a hedge fund, please bring it to us as an ETF. I think they'll make the move. But one of the things we go back to is the hedge fund strategy itself. Can it conform to the 40 Act? The portfolio limitations, the restrictions on derivatives, use of a Cayman subsidiary if some of your securities have bad income that just won't fit and won't qualify. And then it's the nature of, would your hedge fund strategy be compatible with market makers? You can't trade too much. You can't trade at certain times. You can't throw off their hedges. They won't be happy. The bid ask will be a mile wide. So it's those real two things for hedge funds. Does your AUM audience really want it in this wrapper? And then can I fit my strategy into the ETF wrapper effectively?
Yeah, true. But are you like, from your seat, are you kind of like seeing inquiries from hedge funds about ETFs, or you are? Yeah.
What's interesting, and I'll be brief on this comment, but what's real interesting is there's a lot of people now, after a long period, Mike, of playing low cost leader. Look at us, we cut our expense ratio by 3 basis points. It's like, okay, great, you went from 58 to 55. Pat yourself on the back. But it was a headline, it was a press release. I think now we're starting to see that a lot of people intuitively recognize that there's going to be a lot of folks who are going to want a share of that expense ratio. We talked about this earlier. You're going to have money available as the ETF sponsor to pay platform fees, to buy data packages, to share revenue off of that expense ratio at certain destinations. So that's giving folks the ability to say, I'd love to be at 20 basis points, but because of all these other cost centers, I might have to be at 45. Answering your question about hedge funds, that's when the hedge funds start to pique their interest again. They don't like 20 basis points expense ratio that has to pay for everything. And they look at their margins and they're thin and they don't get great until high AUM levels. So I think to your point, Mike, as ETF expense ratios are accepted at a little bit higher rate for those hedge fund strategies, yes, I think they will come back in. Yeah,
interesting point. So speaking about kind of, that and the future, where like, so the industry has changed obviously so much in the past couple of years. It's like, it's crazy, and will continue to do so. Where do you see it kind of in the next 5 years? When you look into your crystal ball, what are you seeing?
Sure. So I call them, I'm not the first one to say this, but the bespoke products, the folks that are coming into the space with captive AUM, and they're creating the ETFs for the use with their clients. I think a great example is the Bluemont funds that just recently launched. And our friends at Exchange Traded Concepts did a great job. They did a massive 351. And Bluemont is really using the strategies that were in the SMA wrapper for the Bluemont clients, but they also want to reach into the ETF space and grow assets too. So I don't think we're going to see a slowdown of people in that category who are creating these bespoke ETFs. The second side of that equation, and another topic that we could talk about for hours on end, are the mutual fund companies that are going to come in. They're waiting for the pending share class approval, and they're going to say, I want the best of both worlds. So that's going to be, I wouldn't necessarily say a flood, Mike, because again, not to go off topic, this is another thing we could talk forever, but every single one of those folks in the mutual fund space, if you don't have an ETF right now, I'd start talking to a capital markets participant, namely firms who do lead market making, and start talking to them about their willingness to, quote unquote, be a partner with you in this venture when you add an ETF share class.
You think on the share class topic, when that gets approved, as we all assume, do you think that's going to be the kind of catalyst for the next step up in ETF growth in the US?
Well, like everything else in the ETF, let's say the regulatory, the operating side, the risk side with CCOs, everyone's going to figure out as soon as we get that final approval from the SEC, what we have to do at the board level, the custodian level, the accounting level, the admin level, all of those things to operate dual share classes. That will be figured out. It'll take some time, but one of the biggest equations is, what happens if I'm a mutual fund family and now I have an operating model for my ETF and mutual fund dual share class, and I go back to where my mutual fund is listed and I say, got great news for you. I'm now offering an ETF share class. And they say, great, get in line with everybody else on the due diligence side. And they look at them and they say, well, wait a minute, this fund's already approved, but your share class isn't approved. So that's the other early stage due diligence a lot of these mutual fund families should be doing, is talking to these places about, how do I get that ETF share class approved for use, just like my mutual fund is now.
Right. Yeah. The devil's in the detail, right?
Right. One other final quick thing, and I'll talk about the share classes. There's going to be a lot of folks who, remember, lead market makers are not obligated to take an ETF here in the States. There's a process where ETF issuers, I don't want to say the word interview, but they have a thoughtful conversation with lead market makers. And it's not uncommon for lead market makers to say, no, I don't want to take this product. So as more of these dual share classes come in, you got to be savvy about how you talk to market makers. How can you enhance the relationship with these firms, i.e. give them some brokerage from other parts of your business? But just having those early stage conversations with capital markets participants, lead market makers, and AUM destinations is a must for anyone who wants to add a share class.
Yeah, actually, this is something that I've kind of talked about recently, because like there's only, to the point about, you've got all these potentially new issuers coming to the ETF marketplace through the share class, but there's only so many market makers out there, right? It's not an unlimited pool. So by default, that's going to create like a potential bottleneck, right? Like supply and demand. So do you feel that as more new entrants come to the market, there's going to be this kind of pinch point where like market makers essentially are maxed out? They can't onboard any new entrants, and then it can create stress in the value chain, and then who knows what could happen. Do you worry about that?
Well, I absolutely do, because, for one reason, and people have to, I think they can understand this, because if you were running a trading firm and you're using your balance sheet every single day, your hard-earned money, and you're putting that at risk, you're going to go to the places that you think you can best deploy that capital and make money. And if you don't believe ETFs are the right place, then let's say a new issuer comes on, they do a dual share class. Now you get stuck with another ETF that doesn't trade, and you're constantly hedging, 5,000 shares short overnight, and you're paying a haircut, and it's burning money. It's kind of a common sense equation. They will deploy capital with the best opportunities in the ETF space. So you better do your best to make sure you present your new ETF share class as a great opportunity for them, not just an opportunity for yourself. Yeah,
no, absolutely. Very good. Okay, to wrap up here, I've got one last question for you, which is my favorite. If you weren't doing what you do now, what would you do?
Oh, I think for me, it's an easy one. I probably, and I don't think the family would agree with this one, but I'd probably be somewhere down in the Florida Keys trying to be a charter captain, taking people fishing every day. So
yeah.
I love ocean fishing and live here in the Midwest, just outside of Chicago. So we fish a lot for freshwater fish, but I get down and I fish in Florida as much as I can. And that would just be a dream come true, to take people out on the water, have them enjoy a day, and make that my office, make the ocean your office.
Yeah, that sounds a good one. I like that. I like that. I hope it comes true someday for you, Mike.
Oh, I appreciate that. Yeah.
Cool. Well, Mike, this has been a real pleasure. Thank you so much for being on the show. I learned a lot, so I always really appreciate these conversations. So thank you.
Well, thank you, Mike. Like I said, it's an honor and a privilege to be here, and I appreciate it very much.